Welcome everyone, my name is Tom Bagdasarian. I am the managing editor of Hanley Wood's Concrete Commercial Construction magazines. Welcome to CC Live and World of Concrete for another year. We have a special treat for you this afternoon. This is Pierre Villere. He's the managing director of Allen-Villere Partners and columnist of Concrete Producer magazine. And Pierre is going to talk to us this afternoon about the state of the industry. This is part 3. You can find parts 1 and 2 at our website, www.theconcreteproducer.com. And I give you, once again, Pierre Villere. Pierre?
Thank you, Tom. All right, this is part 3. We looked at an overview, and we looked at size and geography metrics. So this we're going to discuss trends a little bit. So there we go. Okay. This is the average yards per participant in the survey, and look how this yardage has grown. This is the recession, and look at the jump we've made here. We've gone from a low of 440 here in 2011 to a high of 577,000 cubic yards is the typical respondent to the survey. So this is up 14.4%, and it's a significant improvement. Needless to say, we like to see that. We like to see growth. We had an accelerated improvement in participant volumes. Average member volume was up 14.4% in 2014 versus a year-over-year increase of 8.5% in 2013. Participant growth, volume growth exceeded estimated industry volume growth of 8.1%. So the industry in 2014 really outperformed the expectations. Industry volumes grew from 300 million cubic yards in 2013 to about 325 million cubic yards in 2014. Still a long way from our all-time high of 458. Volume per participant is still 36% below that in the industry peak profit year of 2006. Average member volume was 557,000 cubic yards in 2014 versus 866,000 cubic yards in 2006. So what does that mean? There's a lot of runway left, and we're going to see there's still plenty of room for the industry to continue to improve. All right, here is top-line revenues. You can see what happened to the price of a yard of concrete. In 2009, we were at $96.05. It fell to $88.39, down 8% over this 2-year period. And then we've seen a jump of 11% up to the $98.23 that we witnessed in 2014. So we're up $2.18, and you've got a compound annual growth rate of 5% from 2009 to 2014. Not a barn burner, but at least it's going in the right direction. Okay, material margin per yard. This is interesting. Material margins dropped from 43.35 to 38.01 at the bottom of the absolute bottom of the recession, but material margins have increased by 14%. They're back up to 43.20. You can see the 2014 margin looks very similar to the margin in 2009. Okay. A materials cost per yard, you'll see that we had a cost that fell during the recession as prices fell on the ready-mix concrete side, and now costs have continued to go up. They're up to $55.03, which is still, given the $96 selling price, that's still within the relative percentage ranges of historical materials costs. Okay, materials costs are up 4% in 5 years, which is not very much. That's good news. Okay, this is a great way to illustrate what makes up material cost. So here in the gray you see cement, and then here you'll see fly ash and slag. Here you see aggregate, and this is other. This would be admixtures, mechanical admixtures, etc. Okay. So you'll see that materials costs were at $52.70. They dropped into the $50 range during the recession, and then started their way back up and came up to 55.03 in 2014. Interestingly, the survey showed that aggregates were up last year by 10%, and cement was actually down by 2%. So aggregates account for the majority of the increase. We had an improvement in the selling price per cubic yard of concrete of 98.23 versus 93.42. This was offset in part by an increase in materials costs when materials costs went up to $55 from $52 the year before. So there is the result is a material margin improvement of $2.10 in 2014. Still a long way to go. Okay, plant costs, you will see, I'll go through this quickly. Plant costs per yard continued to decrease, and that is a sign of an industry that learned to tighten its belt in this last recession. And plant costs, as you can see, on the fixed side have continued to come down to $5.38. This is fixed, and their variable cost has also come down from their all-time highs. By the way, we're going to see this in this current slide. On delivery cost, there was utilization improvements that were offset by fuel and R&M increases. You can well imagine that the results of 2015 survey is going to show that there was significant improvements in fuel prices for the average producer. So here you'll see that delivery costs, trended in the $24 per yard range, came down a little bit in 2012, and the industry's done a very good job of trying to improve their utilization, and as a result have kept a lid on both their plant and their delivery costs. Mixer productivity. This is an interesting measure. How many yards do you get out of a mixer truck every year? It's an important measure of fleet utilization and efficiency. So this is up from 4,000 yards in 2009, a lot of parked vehicles and a lot of slow demand for concrete, and that's moved up to 5,183. We are still well below the 2005 average of 5,850 cubic yards in round numbers. So we've got a long way to go still from the standpoint of efficiency. Okay, plant cost per yard decreased from $12.56 per cubic yard in 13 to $11.64 in 14 on better plant utilization. And yards per plant increased from 43,613 to 48,000.6 in 2014. So again, just a further illustration that that utilization and efficiency are increasing. Delivery cost per yard decreased slightly from $23.77 to $23.68. This reflected better utilization, lowering fixed cost per cubic yard. Truck utilization continued to improve, as we saw in the prior slide. We're up to 5,183 cubic yards. This remains 12% below the 5,846 level achieved in 2005. So again, there's still a lot of runway left here. Trends in SG&A cost. SG&A is probably the poster child for where the industry has done the best job. It has continued to cut its selling, general, and administrative costs, and our entire industry is operating more efficiently on the SG&A side than they ever have. So, the participants have achieved operating leverage by continuing to contain their SG&A costs. Selling cost per yard decreased slightly from $1.67 to $1.64. G&A costs decreased from $4.66 to $4.14. Every 25 cents counts in this business, especially when you're only earning $2.23 a yard, as the average producer does. So SG&A costs per cubic yard have decreased by $2.52 from 2009 to 2014. And if you recall, the industry earned $2.23. So all of that has been achieved, you could say, by tightening up that cost of running the office and the selling effort. Trends in profit before tax. Here you'll see that operating profits per cubic yard were horrendous through the recession, finally turned back into the black in 2014 at $223 a yard. We still have a long way to go in our journey. I showed this in part two. We're still a full $5.40 per cubic yard less than our peak profitability of 2006. But we're forecasting blue sky ahead. If you look at this, we are at our low of 257. We finished 2014 at 324. This was estimated at 340. We think this number was really 330. And there's a 37% increase expected between now and 2020. This 445 gets us very close within the margin of error to the 458 million cubic yard mark from 2005 and 2006. So here are our thoughts. The biggest risks our industry faces as we head into this upturn are what I've been saying for the last 2 years, and it's worth repeating, dealing with the potential for good growth and the strain that will place on working capital and deferred CapEx. But we have since tempered our view. We think this recovery is going to continue to be slow. Now, new challenges face us this year as the unknown of a global, and I put China in parentheses, economic slowdown and cheap gasoline have cast a shadow over our modest pace of recovery. And it's interesting to note Ed Sullivan pointed the same thing out in his presentation here earlier today. He's got the very same concerns we do. While the industry turned the corner in 2013, we saw an increase of volume to 300 million cubic yards, but the construction recovery seems to have taken a pause in 2015 as we finished the year flat within the margin of error compared to 2014. There's three famous L's that are responsible for this pause, which are lots, labor, and lending. And labor in particular will continue to be the challenge for our industry and construction in general in 2016. Our industry's recovery will continue to be gradual at a mid-single-digit rate of growth for the next few years. This change in our view has tempered our position on shortages in raw materials, rolling stock, and equipment essential for the next growth cycle as we had previously predicted. And I'll say again, there's a lot of runway left. We've got yet again a third more to go from a volume standpoint just to get back to our historical levels. The gradual pace of the recovery will allow materials and equipment suppliers to plan for cement imports, assembly line expansions, etc., and assure a more steady supply to our industry, tempering disruptions we had previously predicted. By 2020, we expect that ready-mix concrete volumes will have recovered to the 2005 peak, taking a full 15 years for the industry to recover from the Great Recession. So with that, we'll see if I'm right. And thank you very much.